Okay, what we're talking about here in problem 53 is this capital gain exclusion. This is in your text on 1113, 1114, 1115, if you want to refer to those pages. So we had this qualifying small business exclusion. This started in 1993. And so we've got these critical dates. So starting in 1993, there was a 50% exclusion between February 17th, 2019, 2009 to 9/27, 2010. This is stock acquired between these dates. It was a 75% exclusion. And then after this 9/27, 2010 date, it's 100% exclusion. Okay. Now, just to be clear, in order to qualify for this qualifying small business stock exclusion, I have to hold the stock for 5 years. If I hold it less than 5 years, then the regular capital gains rates apply. But here, but here, if I meet this 5-year threshold, then it's these particular percentages. So now, and this exclusion applies before my capital losses. So I take my exclusion amount times the exclusion amount, and then my capital losses then come after that calculation. So let's look at now this 53. And this exclusion only applies to non-corporate shareholders. So if I'm a conduit entity, then I can get the exclusion. If I'm a regular C corporation, I cannot get the exclusion. So Rad Partnership was organized by 3 equal partners, 2 individuals, and DESPA Corporation. So the first thing is we know that DESPA does not get the exclusion. On June 10th, 2011, Rad Partnership purchases all these shares for $36,000. Well, this is 2011, so this qualifies now for the 100% exclusion. Okay, so stock for 180. So each of them get a $28,000 gain. Each of the 3 get a $28,000 gain. Corporation's going to have to recognize $28,000 gain. And the 2 individuals get 100% exclusion. In addition to that, because they each have $10,000 capital losses, they're going to be able to take capital losses $3,000, because remember, there's no capital gain to offset it, so their capital loss is going to be limited to this $3,000, the old rule that we've talked about before. All right. 56 is kind of an interesting problem. First of all, we have to calculate what happens originally. Okay, I sell some stock in 2019 for $11,800. I then had some selling commissions of $600. So $11,200 would be my amount realized. And my purchase was for $18,400 plus my commissions of $800. which gives me 19,200. So 19,200 as my basis in those shares produces a loss of $8,000. All right. Now, this is where this problem gets a little bit interesting. And what they're asking now is, so what am I going to do here in order to do some tax planning? Well, first of all, we know that any gain greater than $3,000 does not do us any good. But any gain that's in excess of $3,000, any loss in excess of $3,000 is going to be carried forward to the next year. We also know that capital losses, first of all, offset capital gains, and then they offset really ordinary income. So, but the problem is let's say I'm in a 28% tax bracket. My capital gains are only going to be taxed at 15%. But my capital loss, if I keep the capital loss, I'm going to get a deduction for the capital loss to the tune of 28%, my marginal tax rate. So in some ways, to offset this loss with a gain, when I could sell it next year and only be taxed at 15%, is kind of a silly deal. So I think the best thing to do here is to take and sell whatever, all of these are long-term gains, to sell a gain, to sell a stock to produce a gain of $5,000, whatever combination of stocks you want that to be. So I'm going to produce a gain of $5,000. That leaves me then with a net capital loss of $3,000 that will then offset my ordinary income at 28%. That, I think, is the best tax strategy. Before there was a time in which we had capital gains were taxed just like ordinary income. And if capital gains were being taxed as ordinary income, then it would make sense to sell enough to produce, again, a $3,000 loss, to produce a $3,000 loss, and boom, boom, we're done. But this calculation got all mixed up when we now have capital gains tax at 15%, capital losses, then the deduction based on my marginal tax rate. So that's the question on 56. Problem 58. What we have here is sole proprietorship, had disposed of any property it owned. So we have this casualty loss on the truck of $3,200. This becomes an ordinary loss. And then we have net capital gains, or net 1231 gains of $6,400. That's the $9,400 minus the $3,000 in Section 1231 losses. This is my net Section 1231 gain. This is going to be an ordinary loss. This is going to be a 1231 gain, which, because it's a gain, is taxed at capital gain rates. Taxed just like capital gains. All right, so that's problem 58. Problem 61 is a much more interesting problem. Because in problem 61, I have a casualty loss and a casualty gain. And I have to net these casualty losses and casualty gains together before I do anything else. We have this equipment that we got $23,000 for from the insurance company, had a basis of 15. That produces, let's see, an $8,000 casualty gain. This is casualty gain. An $8,000 casualty gain. We then have a casualty loss of $10,000. The reduction in value was $10,000. Didn't exceed my basis, so we're going to use the $10,000 minus the $4,000 insurance reimbursement, going to give me $6,000 then of my casualty loss. This then produces a net gain of $2,000. And because this is now a net gain, this net gain is a Section 1231 gain. Okay, now we have to look at what else happened during the year. I have net Section 1231 gains and losses. My net Section 1231 gains and losses are a $1,000 loss, Section 1231 loss. So I'm going to net these two now down to a $1,000 net Section 1231 gain. And that's how this whole netting process works. All right, so that's 61. I'm now going to talk about a problem that I did not assign to you. At least I don't think I assigned it to you. I did not assign it to you, and that's problem 62. And 62 deals with the 5-year look-back rule. And if we were in class, I would tease you about Terminator 2, where Arnold Schwarzenegger comes up and puts on a glove and says, "Talk to the hand." 5-year look-back rule. Talk to the hand is 5-year look-back rule. And what the 5-year look-back rule does is it doesn't change the amount of the gain. It only changes its character. It only changes its character. So it changes the character from capital, from being taxed as a capital gain. 1231 gains, remember, taxed as capital gains. Section 1231 losses are taxed as ordinary losses, not subject to a $3,000 limitation. And so it used to be that we would plan. We would sell all of our loss assets in one year. We would sell all of our gain assets in another year. So we got the best of both worlds. Congress didn't like that and established the 5-year look-back rule, which means I go back from the date of sale and I go back 5 years and I look at, have I had any gains or loss? Have I had any losses that I need to then change the character of that gain from a capital gain to an ordinary gain? So we're going to look at, I'm going to just list these out. I think this is the easiest way to do this. 2015, 2016, 2017, 2018. Okay, so here we have an $8,000 gain. We have a $6,000 loss. a $13,000 loss, $11,000 gain, and a $15,000 gain. So 2014 doesn't matter. 2014 was a gain year, so we don't need to mess with 2014. 2015, we have a loss. Nothing we need to do about it for right now. 2016, then we have another loss. But here in 2011, we have $11,000 gain, which means, so the question is this going to be taxed as a 1231 gain or as ordinary gain? Well, we're going to look up here, and we're going to take this 12,000 or this 6,000. So this is now gone. We're going to take the remaining 5,000 here, give me $8,000. And so all of this now is taxed as ordinary income. All $11,000 of my gain is taxed as ordinary income. And this leaves me with $8,000 that's still tainted with this loss. So I come to 2018. I've got to get rid of this $8,000 to make this zero. Get rid of this $8,000. This $8,000 is now ordinary income. The remaining $7,000 is then taxed as a 1231 gain, probably capital gain rates. Now I come along to 2019, part B of this problem. $2019, I have a $19,000 gain because I've already recaptured all of my losses. I've already recognized income to the extent of my previous losses over the last 5 years. This now is all Section 1231 gain. All right, that's 62. And now 64. Avalon buys equipment costing $150,000. This should be a piece of cake for you because this type of problem was the subject of my lecture, my chapter 11 lecture, so this ought to be easy. So the first thing we have to do is we have to calculate, and this in fact has all three of these scenarios we talked about earlier. So the first thing is we have to calculate what my adjusted basis is. And I took $94,000 in depreciation. So my adjusted basis now would be $56,000. So now I sell this equipment for $90 minus 56 is, let's see, $44,000 gain. Because this $44,000 gain is less than the depreciation that I took, this is all Section 1245 depreciation recapture. I now take 155 minus 56 gives me a $99,000 gain. Well, here my gain is $99,000, but my depreciation that I took is only $94,000. So $94,000 of that, let me do it this way. $94,000 of that is going to be Section 1245 depreciation recapture. The other $5,000 is going to be a Section 1231 gain. Okay? Remember I told you this was the hardest scenario. This is the second easiest scenario, in which the difference between these two, the 155 and the 150, is my Section 1231 gain. And the last one is actually the easiest. Again, my basis is $56,000. I sell it for $40,000. It's $16,000, a straight Section 1231 loss. All right. That's the end of the chapter. We'll spend some time with chapter 12. We'll be able to get through chapter 12 then in the next 3 days. And be safe. And I'll talk to you either tonight or tomorrow morning. Bye.